say that, but now I think people are worried about different things.
Good evening. How's everyone tonight? One advantage of a professor voice is you don't need a microphone, which is great. So I'd like to welcome all of you tonight to tonight's terrific program on tearing down the pink wall. We have four amazing individuals on stage tonight who are going to talk to us about opportunities in the markets right now, as well as careers in investment. So we're looking forward to that program tonight. For those I haven't had the pleasure to meet, my name is Chris Schwartz, and I'm Associate Professor of Finance here at the Business School, as well as Faculty Director of the Center for Investment and Wealth Management. The center's goal is to provide financial literacy education at all levels of the community. Of course, that includes community programs like the one we have tonight. We also provide education at the high school level. We have two programs, one called Life Fest, which is a program for underserved children. We bring them here in between 8th and 9th grade. They stay in the dorms over here on Middle Earth, eat dorm food for 3 meals, which generally consists of ice cream for breakfast, ice cream for lunch, and then some additional ice cream for dinner. And we use financial literacy to motivate and prepare them to be the first in their families to go to college, and we've done that program for 8 years. We have a second high school program called Investments, Financial Planning, and You. This program is a day camp that we provide to students who want to kind of learn Investments 101 when they're still in high school. Everyone that teaches in that program, such as myself, do it for free. We use those proceeds to help support the Life Fest program. At the UCI level here, we do lots of things. So for example, we have a stock market competition for the second year that has 400 people competing. So I look forward to seeing their investment strategies in this volatile market. Maybe I'll get some ideas. We also have, or not, maybe things, what not to do, right? Maybe that's what but we also have financial literacy courses on budgeting, student loans, credit cards, and so forth that we provide to all students for free, either in person or through online modules. And then finally, we have in-person undergrad and MBA wealth management courses. So we do a lot of things here at the center. Everything we do at the center is possible due to our board members, so we receive no funding from the school or the state. So we're able to do this from our 40 board members, as well as additional donations for Life Fest from people in the community, as well as other businesses in the community. And so for any board member here tonight, I'd like to thank you for your support. Of course, additionally, especially like to thank PAMCO and PIMCO, who have representatives tonight on the panel, and our members of the center for all their support. So Roger and G and Jane, thank you so much for all of your help. We are partnering tonight with WISE, Women Investing in Securities Education. They've been a terrific partner for us for over 7 years now. We've done a lot of programs with them. And so we're very grateful to have that partnership with Angela Daly and Darlene March as the co-chairs that help us put on this program together tonight. Look forward to tonight's program. Of course, many opportunities in the future as well. All right, so before I hand the baton off to the next person, I'd just like to take a moment to thank a couple people here in the audience. So the first one is David Karachuk, who is hiding over here. David is with LPL Financial. He is our chair of the program committee that puts on the community and professional programs. And so David worked tirelessly to work with WISE to put together this program tonight. I'd also like to thank Leanne Mackey. She's the associate director of the center. So I'm the faculty director, so it sounds more important, but she's really the more important person at the center. She's part of the thought leadership and, of course, does all the work to organize and put on tonight's event. And so appreciate that. And then finally, Kara Duckworth, who is our co-chair, and she just is an amazing support of the center for the last 11 years. So let's all give them a round of applause. So, without further ado, you guys are already sick of hearing me talk, so just imagine my poor MBA students that have to hear me for 3 hours straight. I would like to introduce Angela Daly to the stage. So, Angela is currently the co-president of the board of WISE. She is also a founding partner of DAI Partners, which provides public relations counsel exclusively for financial services firms. Before founding DIA, she was a senior vice president and on the board of directors of Drexel, Burnham, and Lambert, where she oversaw award-winning ad campaigns, public relations, sales promotions, as well as employee communications. She got her education at Trinity College in Washington, D.C. She's been on many boards and is currently serving on many boards, including the YMCA of the City of New York, as well as the Financial Women's Association. She splits her time between New York City and Southern California, so we're very fortunate she decided not to be back in the nor'easter that's going to hit tomorrow and be here tonight with us. So thank you, Angela, so much.
Thanks, Chris. Well, thank all of you for joining us tonight. How many of you have never been to a WISE event? I haven't. So we have a lot of potential new members here. Just go to our website, www.wiseinvestors.org. Sign up. The price is right. It is free. All right. So for 20 years, WISE's mission has been to educate females of all ages and all socioeconomic situations on how to better manage their finances. Because we believe that better managing your finances gives you more options in life and more opportunities to fulfill your dreams. We do this through workshops, events such as this, and partnerships with other organizations in Orange County, such as Girls Inc., Girl Scouts, Women's Sage, and of course our wonderful partners here at UCI. So far in 2018, we have had about 15 workshops and events, reaching about 1,500 females of all ages on a variety of topics. We're an all-volunteer organization. We have no paid staff, and we're able to do this because of our wonderful board members, and some of them are here tonight, so just raise your hands. Lisa, Stephanie, I saw you come in. Okay, so we have a very, very special evening tonight, a star-studded panel and a celebrity moderator. Yes, we do. Our Pink Wall series was conceived to feature women in asset management in a holistic way, help attract more women into financial services, and help move them to the C-suite. This is our 4th Pink Wall event. We have had 2 in New York for the media, and this is our 2nd with the Center for Investment and Wealth Management here at UCI. The first featured Christy Mitchum, who is the CEO of Wells Fargo Asset Management, and she spoke about career and family. So tonight we have an extraordinary investment panel, all highly sought after for their investment expertise from some of the largest and most sophisticated investors in the world. They all happen to be women, and they all happen to reside in Southern California. This is a very elite group. According to Morningstar and other sources, only 10% of portfolio managers are women. And unfortunately, the number's going the wrong way. So with that, it is my great pleasure to introduce our moderator, Consuelo Mack, founder and host of PBS's award-winning Wealth Track. Consuelo and I go back a very long way. Yes, we began our careers in New York at the same time. She as a journalist and me on the dark side in public relations. And over the years, our paths would cross many times in the pursuit of stories, sometimes not happily for me, and I can tell you firsthand she's a lot tougher than she looks. Consuelo is one of the most prominent and respected financial journalists in this country. She's a pioneer in business journalism, a former anchor at CNBC, and now she hosts her weekly show on PBS, Wealth Track, that's devoted to helping all Americans build and protect their wealth. She's a very strong advocate of women in the workplace, especially women in finance. Consuelo has impeccable credentials, but what distinguishes her is her integrity, character, devotion to her family, friends, and community. And tonight she's demonstrating her dedication to financial literacy by coming all the way from New York City just to moderate this panel. Thank you, Consuelo.
Thank you. When you have lifelong friends like Angela, and I think there are some much younger people in the audience, and actually everyone in this panel is younger than I am, not younger than Angela is. But you realize how important connections and support are. And I'm looking around this room, and I'm looking at these panelists, and we all owe a tremendous amount to our women friends, both professionally and personally. And it makes our lives much richer. And I think that when I think about WISE, which I got involved with 21 years ago, It was a group of professional women, you know, who worked full-time. They were academics. They were in the financial services industry. They were kind of groundbreaking individuals in their own right. And yet they felt it was so important to share financial literacy with young girls and women of all, you know, everyone of ages and from different means, different socioeconomic backgrounds, and different skill sets. And they've been doing it now for 21 years. And I am in awe and in gratitude of them, number one, and Angela getting involved through my introduction, and she's, you know, I don't know if she's ever stopped to thank me for, because now she's probably running WISE and has been for the last 10 years. But at any rate, it just, the awe and gratitude that I feel towards the women who are the pioneers in this and also are continuing the work continues. So my awe and gratitude extends to these women panelists, and I say we are women, but first of all, we are, you know, they are professional investors, and they have made it to the top of their careers. That it's very difficult for, it's an industry that's very difficult for anyone to crack, men or women, and the fact is that they are at the top of their game. They have tremendous responsibilities. You know, we're looking at assembled, you know, billions, tens of billions of dollars of assets under management that people depend upon for pensions and for retirement, and institutions for supporting, for endowments and education and everything else. So the fact that they are here in the midst of what is, you know, a kind of a market meltdown, and that they're willing to devote time to this, to all of us, to this cause, to women in particular, is really a phenomenal statement of their dedication and commitment to women and to financial literacy. So I just want to thank you all ahead of time for doing that. We have two missions here tonight, and one is to find out what on earth is going on in the markets and have them share their expertise with us, and also to find out what they're doing under these circumstances, both with their funds and also we are going to get personal and talk about what they're doing with their personal portfolios. And the second mission is to find out how they have made it to where they are, how they've succeeded, both as you know, investment professionals, but also as women in a profession that is notoriously not friendly to women in general, and to get some career advice from them. So I'm looking at, you know, the students here among them. This is just a golden opportunity for all of you to really get some advice from people who know how to get ahead and also have helped a lot of people along the way. So without further ado, and we're going to have time for questions afterwards. One of our panelists has to leave at 6:15, and so we're going to save. We've got two separate conversations that are going to happen here in short order, but we want to make sure that you all have time to ask questions as well. And it is a small enough room that we can actually, we've got mics that will roam around the room, but also for those of us with loud voices who don't need mics like Chris and myself, you know, you'll have an opportunity to talk as well. So I wanted to start with Sarah Ketterer. And she is, because she's an equity manager, and that's kind of where the action is. That's where all of the headlines that we're hearing about are, even though there's stuff going on in all of different asset classes, which you will find out from she and also from Jane. But Sarah is a global value manager with a superb long-term track record. She won Morningstar's International Stock Fund Manager of the Year award last year, which is a big deal. She is CEO and co-founder of Causeway Capital Management, which she started in 2001. It has, I mean, I've lost count, but it's $60 billion plus in assets under management right now. She started in 2001, as I said. She is a portfolio manager of Causeway's fundamental and absolute return strategies. That they do both fundamental and quantitative research, including, is it 5 of its 6 mutual funds? Is that, or am I? Six. There are 6 mutual funds, right? Yeah. And including the flagship Causeway International Value Fund, which got the Morningstar Award. Chi Wang is, I'm delighted, this is the first time I've met Chi, so it's great to have you here, is lead portfolio manager of PIMCO's Global Macro Hedge Fund Strategies. $6.8 billion of assets under management. So she's basically managing portfolios with all different assets involved in them. So you're talking about stocks and bonds and currencies and commodities, you name it. She's a managing director and a member of PIMCO's investment committee, which is also is a big deal. And her background specialty is fixed income. So she's going to kind of fulfill that part, that asset class for us, as well as all of the others. And Jane Buchan is, and I've met Jane at another event where she also helped with financial literacy for women. And she just stepped down as CEO of PAMCO, make sure we get that distinction, which is a leading institutional investment firm dedicated to offering alternative investment solutions to the world's preeminent tax-exempt investors. She co-founded it in 2000, and it's based in Irvine. It's got offices around the world, and it has a reputation in the industry for raising standards for alternative investment industries for its best practices. The retirement was planned from PAMCO, because as she described to me that she wanted the kids to take over. And, Jane is a kid to me, but nonetheless, there's another generation coming up. And but she's not really retiring because she's she's spinning off a product of PAMCO and into a new fund in fixed income alternatives, and it's going to be called Martlet Asset Management. So whatever she can tell us about that, she will, but you haven't really gone public with that yet, so maybe not a lot. But we'll find out about hedge funds at any rate. And I'm going to say with all three, we'll talk about in the more personal part of this conversation about what they're doing with financial literacy for women, because it's a very important part of their lives. So Sarah, I'm going to start with you. You are not surprised, in fact, that the markets are doing what they're doing, that they're correcting. And you shared with us two charts, one of which is behind us. So let's look at the first chart. And it's a graph of central bank balance sheets and showing them shrinking. So walk us why this is so significant.
It's the first lesson I learned in the world of investment management is where is liquidity? Because the direction of liquidity will dictate where asset prices go, generally. And we've been through this glorious post-global financial crisis, post-2008 period, where central banks nervously have expanded the money supply. They've been buying bonds and other assets hand over fist. And that's not a little buying. This may be more buying than any of us will ever see in our investment careers or in any career. Think about balance sheets, bank balance sheets. We're talking about central banks. They're the banks we depend on as a society. Our Fed, for example, or the Bank of Japan, or the European Central Bank, quintupling. They've gone up fivefold. The European Central Bank balance sheet is waddling around at $5 trillion. The reason why the central banks have done this is because they were very nervous about their economies. They wanted to get interest rates low. They wanted banks to lend more, so they expanded bank reserves in a process called quantitative easing. Well, the chart I'm showing you should be entitled "The Party's Over." And that's one of the reasons why asset prices aren't going to continue to go up in such a stair-step fashion. They're supposed to be volatile. That's normal. We think about the equity market as a rather rough and tumble affair. Stocks go up, stocks go down, but ultimately, if there's good earnings support, then a stock will continue to rise. However, what we've noticed in the last, say, 7 or 8 years is not just that earnings have risen for many stocks, but their valuation multiples have gone up as well. In fact, interestingly, the more excitement, sometimes no earnings, just revenue growth, think Amazon. The more revenue growth, the more investors got excited because, again, there was so much money created, and therefore they could buy stocks on leverage. They could borrow on their home that had gone up in value. Liquidity makes all asset prices rise, from bottles of wine to old master paintings. It doesn't matter what it is. And now we're seeing a little bit more rationality. The valuation multiples, you've heard of price earnings multiples. Well, that's just one of many different valuation metrics. Those went up, and now they're receding. Because, and this is where it gets a little technical, but for you business school students, think about what a stock really is. It's the present value of all the cash it can generate from now into perpetuity, because that's what it does. It generates cash. The present value of that is what it's worth today, theoretically. But there's something called a discount rate. You can't, it's not just, you have to discount all these cash flows because we have inflation. And that discount rate is going up. And it's gone from, in some countries, 0. So there was no interest rate at all. I mean, that's a pretty radical thing to do. And now it's rising because that discount rate is the discount rate is rising. That stream of cash is worth less. And that's one of the reasons why stock markets are more volatile, because investors are being a little bit more careful about what they pay. Where it goes from here, we could all speculate. No one really knows. That's the beauty of equity investing. But what we do know is that volatility is normal and it has returned.
So just a question about this, and actually, so now we've moved on to let's go right to the second chart. So that was the quantitative easing, and as the central banks withdrew liquidity, you're saying, so this is going to be a problem. We've had this.
Well, in a way, it was a problem that we had so
much
money
to begin with, right?
They got a little bit excessive, and the excess could be seen in the valuations of many stocks that attracted investor attention. You could see it, frankly, in cryptocurrencies. You could see it in anything that looked exciting where liquidity could go. Investors needed returns, and we'll hear, I'm sure, more about the chase for income. People need money to retire on. They need to grow their retirement assets. They're looking for returns, and all of us managers are out there searching for them, so we bid up these asset prices. But in the chart you're seeing now, I work with an incredible group of quantitative portfolio managers and researchers, and they've shown the rest of my organization that we get to a certain level of what we call high price earnings ratio stocks. We measure this as the reciprocal. This is earnings yield, earnings over price, but it could very well be, just think about it as PE ratio. And all that chart shows you is that when we get to this extreme level, take out to that bubble period, typically what happens next is the cheaper stocks that were left behind, they start to have their day in the sun. And in the month of October, which has been just a terror for many investors, the more underpriced stocks, what we call the value stocks, have done much better than the growth stocks that have had a comeuppance. Not that I'm enjoying this or anything.
Exactly. As a value manager, yes. Chi, what is your analysis of this, of the fact? I mean, when you said that the European Central Bank had $5 trillion, is that right, in assets on their balance sheet?
Exactly.
Just to put that into perspective, the U.S. federal deficit next year is going to be like $1 trillion. So that's how much money the European Central Bank had. It's just mind-boggling. But anyway, when we've seen this kind of this withdrawing, this shrinking of the balance sheets of different central banks around the world, tell us about what impact that is going to have on the bond market.
Well, I think Sarah said it right. It's like liquidity drives everything, right?
Right.
And everything. So certainly the central bank balance sheet reduction is a reduction of global liquidity conditions. So first order is a volatility effect. Volatility is going to go up. Of course, in terms of even you have valuation derating because volatility go up. If economic growth is there, if your forward earnings still grow, the stock market can still go up, but as like a bumpier path, right? And then the liquidity and decided risk premium and the bond market or equity market, we haven't had a hurdle rate for a long time because you have the short end at 0 and the massive balance sheet. Now the balance sheet is reducing, and meanwhile the Fed is raising interest rate as well. So both in the short end and long end, the short end is just the overnight rate, and the long end is the risk premium, what the duration risk, the quest, like the necessary compensation for taking the duration risk, which is long-term interest rates, and that discount rate for equity assets and for most assets are going up as well. Mm-hmm. So I think the way you think about liquidity, irrespective of what you think the impact on the real economy, the earnings growth is, it's just on the discount rate itself, where that future cash flow is discounted to both in equity space and in fixed income space, and also the appropriate risk premium for you to take duration risk and equity risk premium for you to take that uncertain cash flow risk is going higher.
Right. So the duration risk is the interest rate risk,
right.
is how sensitive an investment is to interest rates.
To interest rates,
Right.
right.
But also, I mean, the other thing that the central banks did, especially, I guess, in Europe, and you can tell me, is that in expanding their balance sheets, they were propping up the bond markets and they were buying corporate bonds. In some cases, they were buying stocks. So what does, again, this shrinkage of liquidity, as you said, how is it affecting the bond market? Most of us, the headlines we see, that's the Dow and the S&P, and we're in correction territory. But what about, the bond markets? What's happening
Well,
there that we're not hearing about?
Well, bond market is going down. If actually, like this month, on the year, right? I mean, the now S&P is down 10%, but on the year, for like say as of a month ago, including dividend yield, and the stock market was almost up 10%, where the bond market was the Barclays aggregate index was down like a 2.5%. So, and if anything, I would think at least the sell-off in stocks this month or this year, I would characterize as a rolling bear market in financial assets and a rolling bull market in volatility assets, meaning you have like episodic increase in volatilities in different asset class. Like early in the year, coming into January, the volatility first pick up in bond market because of the fiscal plan, the tax plan, and then the U.S. 10-year rate sold off almost 30 basis points. And then the discount rate went up, and you have that big drop in equity market in early February. And then the market stabilized, and you start to see the weakest link in emerging market. And the emerging market volatility start to pick up, right? And then
and volatility is just I mean, really market dynamics. How much they're going
move,
up and
right?
down, right?
And then even like lately in the fall, the equity bear market or the sell-off didn't start until we had another bout of volatility in the fixed income market. And the 10-year rate sold off from like a 290 to 320, so 30 basis point increase in very short period of time.
Which is a third of a percentage point again.
Right. And if you think of equities as, I don't know, you model international equities, but if you think generally speaking, if you think it's a 20-year duration asset, 30 basis point sell-off, that itself is a 6% in valuation, not even including the increase in equity risk premium. So I think the bond market actually has been the driver for the most of the de-rating, I would have put it, in the financial assets this year. And of course, I think the earnings revision are going down. So if the forward earnings start to come down, then the growth is going to become a major driver of equity valuations as well.
Right. So Jane, in the hedge fund world, the alternative space world, what's your view, number one, of what the central banks are doing? And this is a sea change. We've had 10 years of the central banks being very involved in the markets and providing liquidity, as you two said, and now we're seeing it's a big change. So how is that being reflected in the alternatives space?
So in the alternative space, what we're looking at is we can actually make money theoretically regardless of what direction the money goes, the markets go. So if the markets go down, you can be short. So you can match yourself. And one of the things that we're seeing is that we actually like volatility because it provides a lot of opportunity to take positions. I mean, I think I step back for a moment and just look at the big picture. So at PAMCO, we're what's called a fund of hedge funds. So unlike these two, we hire managers. We hire people like this. So we're a little one step removed. So to me, I look at more sort of the big picture. And when I was in grad school, macroeconomics was really confusing because I had, for one semester, a professor who said everything's totally efficient, Robert Barrow. And for the other semester, I had a professor, Greg Mankiw, who said the markets are animal spirits. Okay, so imagine, how do you take a test? What's the answer?
It depends on whether you had animal spirit.
Yeah, exactly. So I've come to the conclusion that over the long haul, markets are roughly efficient, but over a 1 or 2 year period, there can be a lot of animal spirits out there. So we actually can coexist. And so when I think about the big picture, and I take a step back, and I think about the big picture here, is that the world got beat up in 2008. Now, I looked at a lot of young people here. You probably were in grade school then, but believe us, we were all in the markets in 2008, and things fell apart. And coming out of that, we had the housing crunch and other issues. And coming out of it, the economy's grown a lot. And the economy's been really productive. And if you think about it with your friends, I mean, even here in Orange County, it's hard to hire people today. The job market's pretty good. And so the economy's doing well. Now, the financial markets sometimes can be really disconnected. There's an old joke that says the stock market's predicted 7 of the past 3 recessions. And in other words, it does things that don't really ever occur. And I think that's true. So what you have is a pretty good economy. Things have come in. But when things get really good, people sort of get overexcited. The thing that I think's done pretty well here is the central banks have been pulling back while people have been getting overexcited. There was a famous head of the Federal Reserve who talked about taking the punch bowl away from the party. That's what Alan Greenspan would say, take the punch bowl away from the party, because when things start getting really good, you just don't want them to get drunker and drunker and drunker. So I think the economy is relatively healthy. It would not completely shock me if you see the markets kind of continue forward on a good thing. It wouldn't shock me if you see them stay here. It wouldn't shock me also if it goes down. I have no idea how it goes. But what's neat about with the hedge fund space is that you can be long and short in different areas, and so you can look at different things. So for example, if we look at the internal dynamics, you've had bonds go up, government bonds go up as the stock market's fallen apart because people get scared, and so they sell stocks and they go buy bonds. Well, that's a very different relationship than as was mentioned for the first part of the year, where it was the other way around. So there's a lot of turmoil, and that's why it's important to follow it.
Thank you. No, but I love it. You know, she also was a business school professor at Dartmouth at the tech school. So as well. So I'm not sure what you were teaching your students, but it's just.
Volatility is a good thing. That's
Yeah.
what we were telling them.
There's a lot going on in the macro environment, and so let me just quickly run through some of the changes. And actually, that she was kind enough to send me PIMCO's secular outlook for. Which comes out, is it twice a year?
Secular is a once a year.
Okay, and it's once a year, so it came out, recently. So I looked at the 2018, and it was, I try and remember what, the title was something like a rude awakening or something, and the point is we are getting our rude awakening right now. So there are a lot of changes. It's not just what's happening with central banks, because the economic environment actually in the U.S. is great, as they just said. It's faltering a little bit in the rest of the world. China's a whole other discussion. But we've got another change. The regulatory environment is being loosened in the U.S. and suspension of some regulations and some revisions. And so there's regulatory scrutiny has shifted from financial sector, from banks and everything else, to the tech sector, to the Amazons and Google and Facebook. So how significant are these changes, the regulatory changes, from your perspective as an international global fund manager?
Well, the U.S. probably would have slowed if it weren't for the fact, and this is a backward-looking guesstimate, but when the Trump administration moved into office, they decided to juice the U.S. economy, and even more significant in terms of fiscal impetus than regulatory relaxation was the corporate tax cut. That was
right.
Huge. And that gave earnings another big lift. And that in turn, because that gave U.S. companies the ability to increase their investments, so their capital expenditures, and they could do that not just domestically but overseas, and that added a little more to the global economy. So I would say regulation maybe not nearly as significant as just one
Is the fiscal stimulus
big fat tax cut.
right?
And the effects of that will go on for years. Outside the U.S., it's been kind of a mixed bag depending on the market. And probably the single most significant macroeconomic effect has been the rising U.S. dollar, and what that has done for indebted economies or indebted companies or industries created a little bit of a problem, because if their debt was denominated in dollars or something linked to U.S. dollars, they suddenly had more debt. And that's like having a noose around your neck and someone kicked the table out from under you. Not so good. In part explains why emerging markets have been a really rough place to be. The calling currencies is far more difficult than even calling markets, so who knows where they'll go next. But we'll all probably take a crack at it tonight.
Yeah.
So, Sarah, I have a question for you. When you think about all years of experience, do you think the emerging markets are becoming more closely linked to the U.S. or more diversified? Because as investors, we sit and we get the case for diversification, but in your view, are they becoming more linked?
Well, if you think about emerging markets as an index, because that's your low-cost alternative, if you'd like to go buy an ETF on the emerging markets, you're going to get largely Asia. Their emerging markets are well over 3/4 Asia in their construct, and the largest single component of that is the China portion, and that's only getting larger through the addition of Chinese domestic A shares. So I think China has a lot to do with the rest of Asia. You almost have to make a China call, and this is quite difficult to do in an economy where the central government's working very carefully to ensure that the statistics that are released are what they want us to see. So I think China goes its own way. I'm hesitating because right in the middle of a rather severe trade spat with China. This is another Trump administration impetus. And we have, as of January 1, the 10% tariff on $200 billion of goods we import from China will go up to 25%. That's tremendous. That's pain. And so that in part explains why there's some nervousness within the Chinese economy and more money seems to want to be leaving. Hence, there's some of the emerging markets. China has really taken it pretty hard. Those stocks are down heavily for the year. And there's some, the currency is getting weak. The renminbi is now, they're about approximately 7 per US dollar, which probably a little weaker than the government would like. Either our government, their government. So emerging markets still look tenuous at best.
And this certainly plays key to the kind of portfolios that you're overseeing.
Yeah.
So how do you, number one, the decoupling question that you had of has the U.S. decoupled from the emerging markets, and also just the fact that the dollar, which was weakening last year, is strengthening against other currencies this year. How do you read that?
I actually find the emerging market very exciting. I manage like the hedge fund, the macro hedge fund, so I can go anywhere, right? In emerging market, I can trade the local rates and currencies, external or even equities, right? And I think for all you young aspiring women and men, I think like an emerging market is actually an interesting area to get into. I think when you ask the coupling or decoupling, when you think about the emerging market cycle, relatively short history, only for the past 15 or 20 years, basically there are two drivers for emerging market. You think at a beta play, either the Chinese investment cycle or the US consumption cycle. And the Chinese investment cycle hasn't been going, and then the US consumption cycle is going, but our current account not going up so much. So structurally, emerging market has been a bear market for 7 years. But because of the China growing, right, and then if you look at emerging market equities, it's mostly the Asian stocks. The composition changed so much.
Right, in the indexes,
in
right.
the index level.
Yes.
But even in this bear market, if you invest in Chinese bonds, you would have made money for the past 5 years, and the external certainly paid to par. So I think
hard to do to invest in Chinese bonds, right? Or
right, but the external, they have a dollar debt,
right?
And I think there's a value there. So emerging market, I think, is becoming a big enough universe. If you're an index investor, you still think about a dollar story and the decoupling. But if you really dig into of the 20-something investing countries, there are actually very interesting like individual stories, individual countries. And then as the financialization in these markets, China, as you said, opened the A-share investing, and then a lot of you get more access. I think there are many different ways to play emerging market. Like even in a year like this in China, you think it's a bear story, right? The A shares down a lot, the H shares down a lot. Local bonds actually rallied, and the currency. I think there's so many diverse ways to play. Like on my team, I'm actually adding resources to the emerging market investing. I think that's going to be a very fertile ground, and it's not depends on areas you play. It's not a pure like a beta story anymore.
So Jane, what's your response? Number one to your own question is what do you think about the decoupling?
Yeah, so I'm struggling with this because if I put Consuelo, as you said, when I put my former professor hat on, you want to be diversified. You don't want to put all all the money on the one lottery ticket. That's just a really bad thing. And so you want to be diversified, but you've got this whole globalization theme that's been going on for the past 30 or 40 years. And so the question is, as you reach for diversification, how diversified are you going to be? And not only do you have the issue with the different countries, you also have the way people invest. So for example, in the old days, 20, 30 years ago, when you invested in real estate or property, you went and bought a building and you got the income from leasing the building. Now you get people who buy buildings, they fix them up, they do all sorts of crazy financial restructuring, they do subprime, and it really is very tied to what's going on with corporate credit spreads. And so one of the big questions for me is, not so much has the risk level gone up because the markets have gone up, but has the risk level gone up for us as investors because of how hard it is to find real diversification today. And I think that's a real interesting.
But
No, that-
do you think, I kind of feel like what Sarah said, for the past 7-8 years, right, I said like
Right.
emerging market has been a structural bear market because
Yeah.
we've all on this basically massive like liquidity injection and then like a growth outperform value. If you look at the leadership, the S&P has been leading everything, and even S&P, the growth has been leading value. But I think with the global liquidity
Right.
going the other way, and now after a big underperformance, you start to see big divergence in emerging market in terms of valuation. I think going forward is actually going to be a more, both even if you only trade equities, I think the dispersion is going up.
Mhm.
And then if you trade multi-assets, the dispersion has been going up already.
So therefore diversity would pay off.
Yeah, I think
Right.
so. I think so. And I think
Eventually.
very, the bigger picture, I think basically whether, we've been in the monetary dominance regime for 30 years, and especially for the past 7, right? But
Right, the monetary, yeah.
Right. When you talk about the regulation, I think that's part of regulation is a specific issue, but a bigger picture, like eventually you may go into a fiscal dominance regime where like the redistribution fiscal policies are part of that, right? If you get a fiscal dominance regime where I think a lot of dispersion and divergence is going up.
So the fiscal dominance regime, what does that mean? That where governments are spending more to
Yes,
stimulate
and,
their
we're going that way.
economy? So like what the
Italy.
U.S. is doing or what Italy's doing,
Like Italy, yeah,
ignoring,
like
right,
most of the
what-
emerging market, like Sarah would invest in, or invest in, right?
Most
But-
markets.
But it is interesting. I mean, I think about this because I trade macro. I think about this all the time, and we debate on investment committee at PIMCO. Not everybody agrees with me. I'm probably the other extreme, right? Where you think we've been for the current generation of investors are so used to inflation is not a problem.
Yes.
So every time
Yes.
we got into a recession, growth slowdown, central banks can cut rates, inject liquidity,
right,
and then get
and boost asset prices, right?
asset
You just said
prices.
stocks
And for most people, I
bonds.
guess you get on your program, people investing today, basically people hasn't invested more than 30 years, and that's the
Right.
one regime, right? But when you think about 1960s and 70s, and I would argue the geopolitical regime and the political environment right now is actually pretty similar to the 1960s, in the US at least.
Mhm.
When you have a populist government, you have very low unemployment rate, right? And then, but the Trump already saying like Paul is too hawkish. We don't like high interest rates.
Mhm.
A lot of like fiscal spending, big deficit spending, and geopolitical pressure is picking up. So you may get a regime where, because interest rates, keeping artificially low, you have very negative real rates, like negative or low real rates, financial repression, and inflation started going up. And in that case, right, and then how like growth against the value, or generally speaking, financial asset valuations, the financial assets against the real assets, I mean that calculation, the return on capital and return on labor can change a lot relative to what we've seen the past 30 years.
Right. So I think change is very much in the air, and we're seeing it illustrated in the markets in a very real way as well. But as a value investor, I mean, is this a great opportunity, what you're seeing in the emerging markets, for instance? And where are you seeing value around the world?
Well, I didn't mean to diss the EM indices. No, we have an allocation model between developed and emerging, and it's been very heavily tipped toward developed for the last 2 years, and it's now tipping over toward emerging, which is quite exciting, and a lot of that has to do with relative valuation. So emerging markets have been beaten up to such a degree. There's the mantra of the value investor chiseled over the door of everybody's office at my firm is, there's a price for everything. Or and the one on the floor says every dog has its day. But there's so many great companies in emerging markets, and I would just point to the Chinese internet stocks, the ones you've heard of, the Alibabas and Tencents, Baidu. They got just like our internet stocks. There was a frenzy, but that's like a popped balloon. It's coming out, and we're now getting to the point. I would point to Baidu, which is a search engine like Google here. And search engines are phenomenal businesses, all that advertising revenue. And then being able to dominate sort of what people see, and as long as you're doing it the way it's supposed to be done there, all good. And they have so many ancillary businesses, and they have a Netflix type subsidiary.
Are you long Tencent? Is that what you're telling us?
No, Baidu, buy Baidu.
I mean, Baidu, right, sorry.
But I mean, these are very large stocks in the emerging market index, and I think they're really good businesses. So a value investor can, when there's a panic, and now Turkey's another example. There are a couple of I know when I say Turkish banks, you're going to start throwing things at me, but that country is not going away. They're in good fiscal shape. They're in terrible fiscal shape, but they have a good debt to GDP ratio. They've just been overspending a bit, and they'll have to kind of slow it down, and the authoritarian government will have to go to the IMF and get a little help, but it will happen. Meanwhile, you can get some of the world's best Turkish banks. That sounds like Turkish coffee. But young population, really productive country at a very low valuation. So there are always opportunities in emerging markets that are exciting.
So hedge funds, Jane, I mean, I'm thinking about number one, fees, the 2 and 20, and just the pressure that they're under, and that hedge funds used to be that you would hedge against, hedge funds were supposed to zig when the market zagged, and they were considered to be a great diversifier. And I'm not sure, looking at the hedge fund indexes, I'm not sure that they are that kind of a diversifier anymore, or are they? And are they, way overvalued, and are they ready for their comeuppance, which they've already kind of started to get anyhow? But
yeah, I mean, the big thing about the hedge fund industry is it's very amorphous. It can almost be what you want it to be. Being a hedge fund's like saying, I'm interested in the mutual fund industry, hedge funds and mutual funds. If you look at a lot of the hedge funds, when I think hedged, you have that D at the end, hedged. Notice how when they talk about hedge funds, there are people, and we've been really, at PAMCO, really aggressive in negotiating fees down, or not even investing in funds that are very directional, very long-oriented. Because why pay a lot of fees for something like that? And those are a lot of the hedge funds that existed actually in the 60s. So that was a really good point you made about the 60s. But what we're seeing is, 2008, a lot of the hedge funds were down 15%. The market was down 40%. So, in a roaring bull market, hedge funds are never going to keep up because they're hedged. And so our clients are a lot of big pension plans. And when you invest, you have different goals and objectives out there. And these big pension plans have to pay benefits. And so we live in a strange world. Because in many cases we're paid, I assume the two of you are paid very much by being very good at what you do. In essence, being the best trapeze artist or the best painter or the best whatever they do. The whole problem is that pension benefits, you can't pay them by being just good at one thing. You have an absolute value. There's an old joke. You can't pay pension benefits by good relative performance. Right. You have to have good absolute performance. And so what you've seen and you're continuing to see is everyone loves to hedge funds, the dog to kick. But actually hedge fund assets today, they just came out with the new estimate, are at all-time highs, $3.25 billion. And when I look at our firm's assets, I mean, we're down 5 or 6% in AUM, assets under management, from a year ago, but we're at June 30, we're $32.5 billion, from 34. So it's still very, very large numbers. And so what you read about and you see is a lot of negativity, but that's not what you see people doing with their money.
I said in introducing you all that we would talk a little bit about your personal investing. And actually, guess who brought that up? It was Jane who brought it up to me when I talked to her over the phone. So where are you investing personally?
So I'll tell you where I'm investing personally. So my job at PAMCO until recently has been overseeing a firm where we interview people like Sarah and G. So we get to ask them questions. And one of the most interesting questions to ask is, okay, you tell us about all the great investment stuff you do. Now, where's your money? And when they say their money is in the garage in a great giant safe, you get a little nervous. So, Consuelo and I were talking about that. So, my money, almost all my retirement savings are actually in PAMCO's hedge fund products because, frankly, I'm a case study about what it is. I don't think that's necessarily the right thing to do for an average investor. I have a fairly high degree of financial sophistication, and I see a lot of stuff that's going on inside. But that's where most of my money is on my retirement, my tax exempt. Hedge funds are very, very bad for taxable money, for people who have to pay taxes. It's like, and so that's why when we say we only do tax exempt money, it's not like we're missing a big part of the market. And then on my taxable money, I am relatively young, few gray hairs. I'm over 50, but I'm still young. Hopefully have a long life here. Yeah, a long life.
That's what we were telling ourselves.
And so over the long haul, I want assets that are going to do well over the next 10, 20, 30 years. And those are assets that look at the growth of the economy, so it would be very equity oriented.
Yep.
Even this. And what's important about stocks, and this is really important, is that it's very hard to time stocks. It's about 3 or 4%. I forget exact numbers. I don't know if either of you know, but days that drive over half the investment performance. And so if you miss those days, you're in big trouble. And I think one of the issues, particularly, and I'm going to pick on you, Consuelo, as a former CNBC anchor, particularly all these financial shows, people tend to get overexcited.
That's why I left CNBC 15 years ago to start a show.
And it's important to have a good long-term investment plan.
Yeah, exactly.
I mean, when we're seeing here, we're paid. We're professional investors. We're paid to invest, and we have different resources and are in a different space. But for the average person, it's good to have a good long-term financial plan.
Yeah. So and this is, I mean, I asked this knowing that, everybody has to say, I've got to invest in my own funds. And most, actually, firms require you to. And I know certainly at Causeway that you definitely do. So, but your taxable money, I mean, where would you put it now? And you are younger than any of us are here, so.
Yeah, I did a pretty major reallocation last year. I always had a lot of money in my own fund. It's a hedge fund, it's a taxable money, but even my taxable money last year, at the end of last year, I switched to my own fund and a lot of like the muni and then the fund net cash investment. Just getting very defensive. Again, I can't emphasize enough, like Jen saying, for the long term, 10 or 20 year, the long-term equity asset. But again, I can't emphasize enough. I think the past 38 or since 1981, right? People in the U.S. really think, unless we get into recession, stocks should be going up every day, every week, every month. We get 8 or 10% every year until you get a recession. And if you don't have to sell, it go up. It always go up. But actually, I mean, lately or the past few months, when I start to think about the liquidity withdrawal and then the cyclical and maybe even secular environment we're going in, and if my view is right, I don't know this cycle or next cycle, you think you're going into the 60s or 70s environment. The S&P as an index level, starting with 1965 at 100, finished at 1981 at 100. Over 15 years, you didn't go anywhere.
More than a lost decade. It was about
there's a dividend yield, right? For good 15 or 16 years, I mean, the cash gave you a return, commodities gave you a return, and then the bonds were losing money and equities were not going anywhere with dividend yield and a bunch of volatility. So at least I think for the next few years, I want to favor cash, munis, my own fund, and some volatility product. I think financial assets are going to go through a pretty tough period with a tough period of like a really very little returns and higher volatility. And I gave a shot to Sarah. I think some international value like so beaten down so much, and I think by middle of next year, dollar probably going to start like a downtrend. I think I will start to shift some money to like international value, but in a very slow pace. I think in my mind, I think next few years the beta returns in all assets going to be pretty challenged.
Right.
My bullish. I think my biggest book is on volatility and actually like absolute return, go anywhere type of strategies.
Sarah, personal taxable funds.
Yes. I start from the what if everything goes wrong? Because that's sort of how you think. I grew up in a family where my father was an investment manager, and we'd around the dinner table, and this was in the 70s, and it was ugly. I mean,
It was ugly.
really ugly. So I'm always thinking about it can go wrong, and stop counting your chickens because they might not hatch. So I keep about a year's worth of cash flow, whatever it takes to run the household and pay college tuitions and so on. I keep that in cash, just with a brokerage firm in cash. And I think that's actually not a bad suggestion for most people, is make sure that you've got enough to cover your expenses. And then you think about tiering the rest based on how much risk you want to take. In my case, I can take a fair amount of risk, and I like to do it in my own cooking. So it's important for my clients to know that I'm invested alongside them, and the way to do that is through our mutual funds. So we have an international fund, a global fund, we have an emerging market fund, and then a global absolute return fund, and then various mixtures like paint of all those things. And I invest in them heavily. We've just launched something a year ago that I'm really interested in, but it's very nascent, but I'll explain it. We've created an ETF version, but it's actually not entirely transparent. It's a exchange traded managed fund. That doesn't make it any less important, but that just means there's a stock exchange traded version of our mutual funds. We've finally gotten to the ETF business. Exchange traded funds are fantastic vehicles, and I really do like them because this whole idea of being in a mutual fund can be a little difficult tax-wise. When the mutual fund actually, when it trades the underlying securities, it can create a certain amount of taxable events, and then you, the holder of the fund, have to pay at the Uncle Sam. There'll be capital gains, and could be short and long term. If you didn't actually sell your fund, you feel kind of gypped. So the ETF concept is very appealing, and I'm now pushing more of my personal assets that direction, at least in the ones we do.
Okay, I'm going to lean on Sarah because she's got to leave in about 15 minutes, and this is going really way too quickly. So we're going to switch gears and talk about just their careers and how they got to where they are, which I know you're all interested in. So just first question, I mean, how much did the influence, because I mean, each of you are very successful in a as I said, in an industry that's difficult for men and women to be successful, especially women. So how did you get involved in the financial industry to begin with? I mean, how influential were your family, education, teachers, friends, whatever? I mean, what was it about finance that intrigued
like
you?
many kids, you watch your parents like hawks. They don't necessarily know your watch if you are. And on Saturday mornings, my father would tear out of the driveway with stacks of investment research on the passenger side of the car. And I thought, wow, he must really love this. He's doing this on a weekend. So after business school, I got into investment banking, which was good finance experience.
But no, Stanford BA in economics and political science, you MBA at Dartmouth Tuck School as well. So kind of early on, you were interested in economics, certainly.
But I didn't expect to go into asset management. I thought I would end up being in banking. And there was a banking and burnout start with the same letter. So I started a database business, and then I was living in New York City, literally ran out of money. So I started consulting and found various investment managers, and my father's firm, he and his business partner were just starting international equity, and I said, you're interested in this data, did some consulting, got a full-time offer, and then to avoid nepotism, I was put in another office behind this vault door with this much older man who was there as kind of a figurehead who actually read the paper all day long. So I quickly hired other people, and then 5 years later, the firm was sold to Merrill Lynch, and I worked for them for 5 years, and they wanted to sell us again, and it's hard when it's literally having the rug pulled out from under you. I didn't want to be sold. I didn't think it was good for my clients, so we started our firm in 2001 and brought over 24 people, no assets, lost money for almost 3 years, lent the business money, mortgaged the house, the whole thing, and finally we started getting paid and had the value wins at our back and then added quantitative investing. So it was a struggle initially, but by far, outside of kids, the most incredible thing I've ever done.
Yeah, and as far as being a woman in the business, what difference did that make?
It's been helpful. It's been helpful.
Really? Mm-hmm.
And that, I mean, I have some clients, and I'll name one, the city of New York, which is the largest municipal pension plan in the United States. They were deliberately looking, and I applaud them for this, for women-owned businesses, minority and women and minority-owned, if they could get that. And they hired us when we were majority women-owned. Since then, I've been diluting my ownership to get more equity into the hands of my partners, the younger generation. But that was a big mandate for us, and it really helped us get going. And there are clients like that who are recognize that if the firm is just as good and it's got a woman at the helm or a large number of women owners or women involved anywhere where they're at the table, that they'll hire them.
Gee, tell us about how you started, and I've got some statistics here which are just shocking as far as there was a terrific in the Wall Street Journal. They did on Tuesday. They did a Women in Workplace insert, which all of you should a section, which all of you should look at, which is a Leanin.org and McKinsey research about kind of the status of women in the workplace, and it's not good. It's actually women in management is actually stalled. And I mean, let me just give you a couple of statistics, because the point is you all overcame the initial hurdle, which is number one, you got into the workplace, but then only the first promotions to management, only 38.4% of them are to women, and so there's this huge drop off between when women get hired, and these are white collar firms, all the big firms in this country. But you get hired on a management track in a white-collar job, and then suddenly the number of who get promoted really drops dramatically. And then by the time you reach the C-suite, I mean you too, it's 22.4% of the C-suite are women. So how did you number one decide to get into the financial business? And I'll say a BA from Yale and in your molecular chemistry and biophysics and economics were your three majors. So,
well, I stumbled upon it. Seriously, really seriously. I grew up in China, and never knew what stock was or bond was. It's a communist country when I grew up. I guess it's still a communist country, but
The most capitalist country in the world.
the most capitalist communist country, right? So, and I came and I went to Yale for college, and that was the first time I went anywhere outside of home, and really even didn't speak the language when I came here, so certainly didn't know what financial market was. And I started very determined, like I want to be a scientist. So I majored started on molecular biochemistry and biophysics.
MB&B was the toughest major at Yale, so she really rocked.
But also because I didn't speak the language, so I feel like
Oh.
math, physics, and everything that was
Everything
easy
in
to
numbers.
understand. So
Right.
it's numbers,
Right.
right?
Yeah.
And then, so at the end of the freshman year, I got an internship at Yale Medical School and was doing research for a summer. And then I lost some passion for it because I like the science, I like the books. I really didn't like the day-to-day details. Where you work in the lab, you kill a rat once a week. That wasn't what I think this very fancy like a scientific endeavor was supposed to be. And then, so I did it for another summer, and I really decided I didn't want to do this. I didn't like the day-to-day. And then at Yale is a liberal arts school, so even though you want to major in science, you got to take like language lessons and social science and other things. So I think economics was in the social science of a category. So, and then I started with a microeconomics and just really liked it.
Mm-hmm.
And then. So once I decided I didn't want to be a scientist, and I pursued, got more interested in economics.
Right.
And so I pursued that major. And then,
And fixed income analyst at Lehman Brothers. I mean, how did that happen? And again, I'm thinking of, you can get hired, as a woman in the financial world. I think you can. But it's just then, how do you get that next promotion? I mean,
it wasn't necessarily so. I majored in economics. I got it, and then I never worked, right? And so I really wanted to work. I thought maybe I want to go back to grad school, but I wanted a job after school. And I think looking for a job sometimes is like dating. Like you don't know what you want, but you certainly know what you don't want. So when I was looking for a job, right, I knew I didn't want a corporate job because I'm not like a really corporate person. And I knew the companies that interviewed on campus at the time were basically consulting firms like McKinsey and then investment banking.
Investment banking,
And then
right.
sales trading. Sales and trading was considered, I think investment banking was considered a swankier version, right? I knew I didn't want to do consulting because I'm not a writer, and then foreigner is like, I don't want to write stuff all the time. And what's the point of giving advice? I wanted to, if I have an opinion, I want to act on it. So I thought I wanted to go to investment banking. No, sales trading, I didn't know. I thought maybe investment banking because that was considered a fancier job. So I interviewed, with both investment banks and the sales and trading shops, and got job offers on both. And then went to New York to visit. And just the first minute I walked on the trading floor, I loved the energy. Yeah, it's open floor, and I love the action. I love the energy, even though I didn't know what really entailed. But investment banking is all the cubicles and the little meeting rooms. It just feels right. The sales trading. So I joined the Lehman Sales and Trading Program. And then.
But how many? I mean, what was the percentage of women in the sales
So
and
there
trading
were
program?
at the year. So I graduated college in '95. There were 24 people in the program. There are 4 women.
4 women, right?
Yeah. So
That's more than I
Yeah,
thought there would be. Yeah. So how was it on the sales and trading floor? Which
it was.
if most of us have read Liar's read Liar's
It was a
Poker,
little bit like
and
that.
it was a little bit like that. It's very rough and tumble and very male oriented.
It's I mean, in this day and age, it would be considered, I guess, I don't know, abuse, discrimination. But other than that's 20-some years ago, and I didn't feel that way. But I would say, that was. I'm a hard worker even this day, but that was the hardest working years of my professional career, the first 2 years, because the job sales trading floor, and at the time, so I started. It's '96 when I really started to work. And at the time, hedge fund was still a new phenomenon. There was the first generation of hedge funds. So I in fixed income, and then the fixed income Lehman was the really big fixed income shop, and the people there had been working 10 or 20 years. They can also have corporate bonds or government bonds, but nobody really understood what a hedge fund did, or interest rate or derivative swap option strategies. They were just new strategies. So that basically, I was this young bee on the floor. And these were big accounts, but nobody wanted to cover. And they throw me a bone and say, well, you can cover these accounts if you figure out what they want to do.
Great.
So I was the first year out of school, but I got really big accounts, all the famous hedge funds at the time. But I was really so scared because I knew nothing about it, right? I knew nothing. So I remember the first and second year, I would get up at 4 because that's when the Wall Street Journal and the Financial Times were just delivered to my house a little bit after 4. I would get up, get ready, read the newspaper from front to back, so I can talk the talk. Make sure I can talk the talk, even though I don't quite understand what they're talking about. And then I would go to show up on the trading desk before 7, and then people would send me to get breakfast, right? All the senior. These days, I would never send my junior to do any, but these days, that was typical. Men or women, you just get people breakfast. And then start to cover accounts, and then get people lunch. By 5 o'clock, your senior people left. Your accounts are left, and I would sit there with my spreadsheet and read my basis book and trying to figure out what's going on with the swaps options, and then leave at 9, and the second day starts again.
So I'm going to stop you just for 1 second because Sarah has to leave in 2 minutes, or maybe do you have to leave now? I was going to ask if you had time for a question, if somebody wanted to ask you a question, but should you go?
You should let her talk for 1 minute about girls who invest.
All right, yes.
This is
critical. Okay,
I'm gonna
because I was going to let you do that.
Well, Jane can add what I forget to. I brought just a little bit of propaganda, and I've looked at it with Leanne, and I think she's put it with the WISE information somewhere, but you'll find it. Jane and I both had the incredible honor of working with a group called Girls Who Invest, and it's about a 4-year-old organization started by a former client of mine. And I deliberately mentioned the city of New York because the former head of equities there, Seema Hingorani, she worked for the city of New York and then left to found Girls Who Invest. And Girls Who Invest is a program that now, it started with just a few summer internships and young women plucked out of college who had no idea, liberal arts backgrounds, knew nothing about investment management, and then trained on the Wharton campus sufficiently to be able to go into an internship and an asset manager and have some idea of what was happening and absorb it all, and then go back to the college campus and spread the word. And the great thing about this organization is it's very diverse. They're reaching women. I was fortunate, I had a parent in the industry, but many young women have never, ever heard of investment management. I'm certain my own daughters wouldn't have heard of it if they hadn't been watching me. So read about it. The Girls Invest not only needs to find more freshmen and sophomore women and get the word out so they can apply for the program, but also find more internships and find more mentors and more faculty members and people who can help this organization grow. 100 young women had internships last summer, and it keeps rising. This year there'll probably be 150 out of maybe 200. It's an incredible program starting from nothing. So we're all very proud of it, and we hope in some way, shape, or form you all can get involved.
And PIMCO's recently become a huge supporter of it.
Yeah.
So.
PIMCO has, oh, great.
Yeah, we
That's
had
true, yes.
we had interns from the
Yes.
program this summer.
Yeah.
It's really a wonderful program. You know,
So-
I felt like it would have helped me a lot when
Mhm.
if I had got into it,
Yeah.
right? Yeah.
Right. So you've got to go.
I do.
Yeah.
I do.
So thank you so much, Sarah Ketterer, for being with us. Okay, we're gonna take- we'll just keep going. Mike, with you, so I was just- we can take that. You can give it to Leanne. All right, so we're going to continue our conversation here, and I didn't, because what a fascinating story you've got. At any rate, I know Jane does too, and we will talk more about Girls Who Invest with Jane as well. But I'm hearing that you basically were willing to do whatever it took, I mean, if somebody asked you to get breakfast, you were willing to go and get breakfast. Or, I mean, was that, but now, as you said, that was, 20 years ago or whatever, now that would be,
No, I don't think it's
No.
right. Like, yeah, I think people are more.
They asked both girls and boys today to
Yeah,
do it.
and
still do it,
time.
okay, they still do it, right, then junior members, so, but.
No, but
if-
even when I started, so
Yeah.
20-some years ago, and I think both girls and boys did it as well.
Oh, okay, so it
right?
was just the
So it
junior member of
wasn't
the team,
right,
right,
the
would do it.
junior member of the team.
Yeah.
Nowadays, I think we're a lot more sensitive, which is, I think, the right thing.
Yeah.
Yeah. But, I think the sensitivity, like diversity sensitivity, and I think that's really part of the cultural element in this day and age, and I think
Mhm.
that's for the better.
Right.
Yeah.
And so Jane, how did you get involved in finance?
So my parents were both professors of medicine. So if you want to imagine what the dinner table conversation was like, I knew I did not want to do medicine. That was just out. So I went to school. I went to Yale as well.
Right,
But
and
something-
BA in economics?
Right.
Right.
Well, sort of.
Oh,
Something.
okay.
That's what my degree says. That's not really what I did. I grew up in the great state of Oregon, where we have a religion which is called track and field. It's probably the only state in the world where even to this day, the track and field news is above the fold, and the football, the Oregon Ducks, is below the fold. So I went to school, and something happened in school, and I became kind of a good athlete. So literally, I remember I had a huge fight with the administration because my senior year, I only was on campus one Friday all semester, and that's just not something you do there. But I was trying to explain, you will support a kid who wants to become a world-class cellist, you'll support a kid who wants to become a world-class academic, somebody who is competing nationally at Olympic trials level in track and field, you seem to be prejudiced against them. So that's kind of very interesting to argue with a school, a Division I school, about how they're prejudiced against sports. But anyway, neither here nor there. What ended up happening is you have to do a paper at the end of sort of a mini thesis for your senior year at school. And
This was high school.
no, college.
This is college.
at
Oh, I'm
Yale.
sorry.
And I
missed that.
I decided I wanted to do an event study. That was a big thing in the 80s when I was there. I did an event study in merger arbitrage, and I ended up needing I did the graduate sequence in econometrics when I was a junior, and I needed help on something. And I went to one of my advisors, and he said, well, there's a really good guy who can answer your question, but he's a total jerk. And he said, I'll arrange a meeting, but just go in really prepared. So I wasn't thinking, and I walked into this guy's office, and, he's got like a double office. He's one of the biggest academics on the campus, and, great, like Louis XIV furniture and all this other stuff. And I'm like, okay, so when I do my GLS and blah, 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 but I'm dressed in track stuff. And so he just answered my question. He said, why are you dressed that way? And I said, I'm going to practice. And he said, practice for what? And I said, sports. There's this thing called sports that some of us do. He ended up agreeing to advise me, and I was sworn to secrecy because he normally doesn't advise undergraduates. And he was a really nice guy, and he adopted me for whatever reason. And I remember at Christmas time he asked me, so what are you going to do when you graduate? And I said, I don't know. And I'm a normal college kid doing sports, kind of going to class sometimes, kind of doing sports a lot. And he said, well, what do you think about finance? And to this day, I laugh because I think I gave him a 5-minute lecture. I was definitely taller than he was. Gave him a 5-minute lecture about the evils of finance, investment banking, and everything else, and how you never want to touch it. And I still remember him holding his papers, smirking, putting them down on his fancy desk and saying, well, Jane, there are a few other things in finance, you know. And so he said, I want you to go to New York and meet this guy. He's a former professor, Wharton professor, and I just think the two of you will like each other. And so I went down and met him, and I met this really interesting guy. And I just, we were talking about things that was just really interesting. And I ignored the fact that he was in this big investment firm. It was like this was an inconvenience. And and by the way, the investment firm was called J.P. Morgan Investment Management, which, by the way, at that point used the acronym JIPM. So think about investment management where they used the acronym JIPM. They've now changed it to asset management to get rid of that JPM. But anyway. And I'm having this great conversation with this guy, and the guy at the end of the day says, I'll tell you what, I'm hiring you and my research team, but I don't know what I'm going to pay you, but you got the job. And I said, great. And I was like, wait a second, I'm working in an investment shop. But anyway, because he was a professor, we were kind of isolated. We wrote a lot of code. We were doing things like cheapest to deliver. It was us competing with Solomon and doing a lot of Z pieces. This is in the 80s when computer time's very hard and you have to figure this stuff out. And what was interesting, and so we were kind of the weird team. There were 10 of us on the team, and we take the bubbles and make cone heads and do other crazy stuff. But what was interesting is the first day, I was brought up in a household that was, I don't know, I would call it proper, this is in the old days. And the first day, he sat me down, and this is what I was telling this to Consuelo, and she wanted me to tell this to everybody. And this is what's so sad about what's happened in our society today, is in the first day he sat me down, and at the end of the first day, he said, you need to stop calling everybody Mr. and Mrs. In the financial world, you go to first names very fast, particularly when you're involved in market making and other things like that. And I'm sitting here like, I've been trained my whole life to call everybody Mr. or Mrs. And so I just was like, oh my gosh, do I quit now? I can't do this. And he said, if you can't do that, just don't call him anything. and so I never called anybody anything to pay you for like 6 months. The other thing he said is because I had been helpful, I guess. I don't even recollect this, but we had a big meeting, and I had offered to get somebody, a cup of coffee. He said, the next thing you need, when you walk into a room, you find the coffee pot, and you go and sit 180 degrees away from it and for this place. And you don't ever offer to get somebody coffee. You're a young female, and you're not going to be taken as the mathematician that you are.
Right.
You're going to be stereotyped as something else. And so that was just so helpful, that advice, like the first day. And one of the things that makes me a bit sad is I think in today, obviously I'm not a guy, but in today's world, I think that'd be a very hard conversation for an older
guy to have
with a
young
woman. And that was some of the best career advice I was ever given, because I'm 10 years older than she, and so when I was around, when I did my graduate work in finance, there were 40 people in the class. I was the only woman. When we did that, and they're just little things that helped. Over the years, and where people were just nice. But it was. I'm not quite the generation like you but I'm very close to that generation where you were first, and it was just very hard. To not be shoved into things. And what's interesting is, unlike Sarah, when we started our firm in 2000, and we grew really fast. And even though we had a lot of women in our firm, we never did the women thing. But
You never did the women thing,
recruiting, even though we're majority woman owned for
Right.
like the first 5 years, we never applied for those mandates or took money under that program.
Right, I see.
And one of the things that I had to do to raise money is I always had to go with a very much older male gentleman to raise money, because I found that I went with someone who was close to my age, or I went with one of my other partners who was female, we would never get the account.
Right,
And that was just sort of the school of hard knocks,
yeah,
which is that, and it was funny because Bill was just a wonderful human being, but he'd open the meeting and he'd close the meeting. That's about all he would say. There wasn't a lot of content
Yeah.
in there. He's a very good investment guy, but totally different. But it was just, it was just very hard.
to get a hearing and have
To
the
get a
credibility
hearing, yeah.
without him opening and closing.
Yeah,
Yeah,
yeah.
yeah, so he
Yeah.
was like the senior statesman. So let me ask you, each of you, about the theory of this unconscious bias. And I know, Jane, you feel that this is the case. And you're all, I'm sure, very aware of this, is that there's a body of research that shows that if it's a blind choice, that frequently the women will have equal opportunity as a man, but if it's clearly a woman, then frequently they're not given the raise or they're not given the interview, whatever it is. Is that something that you two believe that have experienced, number one, or that you're making an effort to overcome, or how seriously do you take it? Unconscious bias, is that theory, Chi?
I'm sure there's an unconscious bias, right? And
Mhm.
if it's not the gender issue or diversity issue, even investing, like when I look at the situation, there's an unconscious bias, right? And then you just have to be so sensitive to it. But I would say, like when the specific situation you're talking about in terms of gender in the workplace or the promotion, both ways. I think as a society in general, like PIMCO as an institution, I think we introduce different perspectives, not necessarily gender, it could be just a background, right, way of thought, and all that, I think, like introducing all these different backgrounds, produce better business results. That's what we want to do it. So I think most institutions and society as a whole has developed more sensitivity and have more like a realization of that unconscious bias and how is that hinder like business results, trying to make improvement. But I want to say as an individual, also, whether there's unconscious bias or not conscious bias, I don't think it ever really do you any good if you walk around life with a sense of entitlement or a victim mentality, right? Certainly, I think society should make it fair and equal for everybody, but as an individual, and I think it just always don't ask what other people can do for me, just what you can do to increase your own, capital and your value to your business, to your coworkers, to others. And I think that's probably the way to succeed, and that's the way I look at the situation.
Right, and so can you give me an example of that, of something that that you do on a regular basis where where you kind of go, I call it, Walt Disney used to call it plussing, is making an extra effort. So where do you make an extra effort to really either help someone else or at work or make sure that the team is diverse, that it does represent different attitudes, and I can certainly think of when I think of the two majors that were not economics at Yale. I mean, that would be considered to be, that's really interesting. Like, what does that bring to the table that like just a straight economics or finance major wouldn't? But just give me an example of how it works in real life.
Well,
Yeah.
I mean, like one, not diversity specifically, but I really like when I run my team, right? And then, people have different communication styles. And this morning I actually had the issue, right? Because market was moving fast, and they're trying to get some information out of a really smart guy with like a Carnegie Mellon and a quantitative school. But I tried to get one answer, he just couldn't produce the answer. Meanwhile, he's writing me a dissertation without a spreadsheet. And I'm really, what is the answer, right? Like, he thinks he's really like giving me all the facts.
Yes.
We're in the fast-moving market, right? So I put him like we settled whatever we needed to do, and after market close, I actually had a conversation with him. Like what is in certain markets and what we need to, like, what is the most urgent,
Mm-hmm.
and then what is we can do like afterwards. But also I run team meetings on weekly, and there are people who like to talk a lot. There are people who don't want to talk, and then you try to seek out. Like for people, typically the vocal ones try to dominate the meeting, and I always, try to make an effort to really say, hey, what do you think? Make sure everybody have a
voice.
And I think it is it's part of in terms of management how you try to get the best out of everybody. Really, trying to provide a system where people of different talents and different styles all have and different seniority all can have a voice, as you said.
Mm-hmm.
And then, like I think Jean said, like you were talking about the mentorship, right? And I think it's also so important. I'm not I'm too busy. It's not I'm sitting there and say, hey, what do you need? Do you need my help? Do you need help? But I think it's helpful. Like when I think about it, like in women's case, actually, I do think in my position, thinking about. And that's the one area I actually try to pay a little bit consciously, really trying to make attention to in terms of, because typically, women come on the floor, they work really hard, but they are just generally speaking, women are not as well qualified as men, right?
Mm-hmm.
And they want to work so hard and get recognized instead of work really hard. I think men tend to work really hard, but broadcast their
yes, exactly.
hard work and accomplish them as well. So I try to make some effort to make sure like that. Make sure they behave, they can be more proud of their own hard work and accomplishment, but also try to provide some type of mentorship.
Yeah, no, that's a great example.
That. Right.
Unconscious bias, you have some thoughts on it.
Yeah, so, I think the thing that's really difficult is you can talk about generalities. For example, on average, women are shorter than guys, but then you look at me and I'm taller than most guys. So I think you have to be really careful when you deal with a subject that you don't forget everybody in front of you is an individual, and while there may be certain tendencies about it. I'm interested in this, and one of the things that annoys me to no end is there's a lot of quote-unquote research done by well-meaning people, but they're not trained academics, and they do things and they come up with crazy answers. And there was a big accounting firm that was running around saying things that women outperformed men in the hedge fund space, and that just didn't sit right. And I kind of looked at the data. One of my skills that I'm pretty good at is looking at statistical exhibits and saying this isn't hanging together right. This makes no sense, and because that's really my background, so mathematics and statistics. And what was interesting, so I gave, being a former academic, I have a lot of friends in academia, and I got we gave a grant, PAMCO gave a grant to them to actually go do a real paper that got published in a real refereed journal. And it's fascinating, and when Nicole and Raj called me and they said they got the first run of the answers, and they said, "Ooh, Jane, got bad news for you. Men and women perform the same." And I'm like, hallelujah. Professional investors are professional investors. People are people. This is really good. Actually, I really like this. And then they said, but there's a really sad thing here. And I said, what's the sad thing? And they said, for the same level of performance, women have to have almost another 1%. So if a guy produces 9, a woman has to produce 10 to have the same amount of money to manage.
Yeah.
So the issue isn't that women and men manage money differently. The issue comes to capital raising.
Yes.
That there's a difference. And I am a big proponent about talking about this with factual, rigorous data behind it, because I think when you see this, you can think about this and say, how is it? And this is why that people have a lot of these programs where they try to get money to women. The problem with that, and too bad Sarah's not here, one of the big issues that I've had in my existence is that I hate it. It's very annoying to me. It's one of the most demeaning things that happens is people will say, you got there because you're a woman. It sort of takes everything else away from you.
Right.
And that is something that makes me, very angry. I'll be really candid because I've worked really, really hard.
You're really good at what you do.
I have performance numbers behind me. All this other stuff. And I think you have to be really, really careful about, people are people are diverse, they bring all sorts of different things. But I do think there are certain sort of overall habits about things. And I think people are moving forward a lot in that. And I know in like job postings, regardless of the industry, they find things that like you no longer write qualifications include, because there's a fair amount of evidence that shows that, again, on average, a guy thought about doing it, he's qualified. A woman did it for 10 years, she's partially qualified. So you get that kind of thing. So
Right.
instead they'll say, are you experienced, or have you had experience or familiarity with it? And it changes the ratio of how people apply. So there's been a fair amount of work in the area of linguistics as to what are the different words to get people
Yes.
to process in the same area. And I just think there needs to be more substantive conversations like this, rather than people pounding the table
Just
for
label something. But-
label things. Yeah.
Right, or just the example, it's interesting hearing Jane, the example she gave, right? If for, you manage money and women have to put up 1% more to get the same amount of money, right? And I feel like even looking at that situation, if I were a capital allocator, right, running fund
Right.
where to invest capital, I think as a community they should think about, do we have an unconscious bias? So for the same performance we give it to men, we give more to men than women. But as a female fund manager, I feel like I should look from the other perspective, say, even though I put up as good performance or better performance, am I not as a good marketer or business manager? And I think like this type of diversity issue is always two sides, and everybody needs to, play your part and think how to do it better.
Better, right.
It never falls only on one side.
We should open this up. Did anyone have questions? Because I realize that I'm failing you as a moderator here by going over time. Any questions from the audience? Oh, great. So right here in the middle. Yep. And there's a mic coming your way.
Fantastic talk, I really enjoyed it. I just have a question about Bitcoin.
Bitcoin.
No, that's you. You're a hedge fund manager.
All right, you put me on the spot. I don't believe it, right? I think that's the global liquidity. There was so much liquidity, so you had this internet coin offerings, and then you have a different. It's like a religion, right? And there certainly doesn't matter how crazy a certain religion is. There are certain people who believe it, and
they've created a market.
Well, and they created the market, right? But for me, when I look at it, it actually led to some of my profitable investment. When I started to look at Bitcoin 2 years ago, and I'm thinking, well, a monetary system, there's, a store of value. There has to be, the liquidity, and Bitcoin certainly doesn't have. But the most important, there has to be something you can create a monetary system, have credit creation. Where Bitcoin, because their biggest marketing plot, there's no inflation because there's only 21 or 22 billion coins.
Right.
But to the extent that if it gets really successful and catch wave, everybody try to settle their transaction in Bitcoin. It's going to use the whole world's energy to mine the coin. It's going to be more and more expensive to mine the Bitcoin. So I turned around and bought Nvidia and some of the mining stocks, which had done well. But even that, they picked when a Bitcoin peaked at the end of last year, and I sold most of that because I think its own success is going to create its own downfall, just because you can't have a credit system build upon a currency with limited supply and use all the world's electricity to mine it.
Yes, in back, and we've got another mic to look.
I think I have a very loud voice.
Yeah, I can hear you.
My question is, I think one of you said there are only a couple of days, you look at the market
Yes.
history, you miss those days, you miss the peak of the market.
Yeah.
I have a dilemma. I have been debating with myself for 6 years, which is I left the company 6 years ago. I have 401k money in their fund. I have to take it out to convert to another place, but they wanted me to convert all in one. It's about, let's say, $20,000, and which means I have to take it out of the market for at least maybe a week or two, and then go in. I don't have control when they will take it out. Because when you say I want to convert, they just process it. You don't know how long it takes. In the current market situation or in any market situation, do you think I'm paralyzed. I couldn't do anything for 6 years.
So I was the one who made that comment, and one of the ways to think about it is, let's say it's 5% of the days. There are 250 trading days a year. So, it's about 13 days a year that you want to be in there on an average year. But you got to take it out. The important point is to do a rollover. And I mean, Consuelo, you're better equipped than I am to talk about this, but you want to do it in a way that also you don't incur taxes, because it's very important to spin it out in a way that you don't incur taxes and you put it in another deferred vehicle.
And also that's it. I mean, the statistics are, it's every year there are days like, days like that. So it's not as if, and if it's a long-term holding, so, what if you miss it like that 1 year, you still got, the next 6 years that you'll be holding it, you'll be okay. So you've just got to do it. So I don't.
But you have to take all of the money out. They don't want me to take it.
That's generally how these plans are.
Right.
It's called a lump sum. They give you the lump sum. The thing, I wouldn't worry so much about what day you take it out.
No.
I think the bigger thing that you want to be careful about is that you're working with somebody who understands the implications, because
tax
there's
consequences,
there's a lot of ways that the money can be transferred, and unfortunately the way the rules are written, as I understand them, and correct me if I'm wrong, but is that it has to go from one tax exempt to another tax exempt, and you can't take it to yourself and then put it in a tax. So it's very complex, but just make sure.
This isn't a 401k, is that right? Or
It's a 401k. I understand the
Yeah.
tax part. I just don't know in the current market because
right.
Listen, none of us would be sitting here, we'd be owning islands if we knew what the market was
Right,
going to
exactly.
do.
Right. So, any other questions? Yes, in back. Here, Mike's coming to you.
Good evening. My name is Leila Parker. My question was, to become the analyst that you work with, do they have a background in how do you say? Like, are they good data analysts as well? Because the market is moving faster, we're having more information, and now more than ever, companies ask for their employees to have a background in that kind of know languages like Python or SQL. Do they have a background like in? Are they really good at Excel, VBA?
So let me just. I've hired hundreds of people over my career being a CEO. So let me just a lot out of college, and let me just give you the 1 and 2 cents. I think at university, by and large, you want to take a diversified curriculum. You want to take, particularly if you're a woman, I think you want to take as much math and science as you can. It will do you wonders over the long haul. But when you hire people, excuse me, when you hire people, let's say you go to the Wharton School. Wharton's one of the top undergraduate business schools in the United States, and you hire someone from Wharton. And then let's go someplace that has nothing to do with finance. Let's go hire someone out of the Air Force Academy, okay, after they finish their service. Nothing to do with finance. So you got two total extremes there. I'll tell you, within 9 months of starting your job, it doesn't matter where you went to college. So, it's the skill set. You get taught a lot. I mean, obviously, you're not going to take someone who's trained in fine arts and teach them, ask them to be your Python programmer. But we hired, at PAMCO, we made a very big hire 3 years ago. I have a little IT company. We hired a guy who ran all of IT for Prime Brokerage, stock lending, Morgan Stanley. Huge job, senior managing director, had $1 billion budget, 500 people under him. You know what his undergraduate major was? English.
Right.
No, seriously, he was an English lit major. And he put he to get spending money, his dad was a psychiatrist, so he's a little warped. But anyway, to get spending money, he wanted his kid to have a job. And I think his dad was thinking, okay, well, he'll go down and work at McDonald's or something else. He made his spending money by writing computer games. Cool. So that's how he learned how to code. And he then eventually, Morgan Stanley hired him because he was a good coder, and that's how the world took off from there. But the point of it is that he's an English major.
Right.
So I think what's really important is it's the skill set you bring, and that's what people are looking for. Where I was hired, I was the only one who didn't have a degree in electrical engineering, but the reality was, even though My degree, that's why I said, when Costello said I had an economics degree, I really did. I took, in order to get my economics degree, I took 7 classes. I was on that campus for 8 semesters. So I took more astrophysics and more other stuff that didn't have anything to do. Why they gave me an economics degree, I have no idea. They just gave you a degree. But the point of it is it matters what you learn to do stuff in depth. Every business, our business, PIMCO, needs people who write well. Good communicators are important.
Who could get to the point in a desperate market
So
situation quickly.
So just
Communications.
what you need to do is excel at what you do, have a passion for what you do.
Yeah.
That's really, really important. I mean,
And the intellectual rigor and discipline.
yeah,
Right.
But
exactly.
you also said that you figured out early on not to work on your weaknesses, because we're all
Right.
is to go with your strengths, work
Yeah.
on your strengths.
I mean, I also think people say work on your weakness. I think that's
No.
the worst advice. You work on weakness, you compete with the people who that's their strengths. You're still going to lose. So I think in life you just got to figure out what game you play and work on your strengths and try to be the best at it, right? Like so. The specific question you asked, I think certainly some technical skills can be very helpful because everybody uses a computer and trying to write something these days. But what I said earlier, I think the different perspectives are very important for a business. So it just you always ask yourself what you bring to the table. But regardless, I think going through life, and especially in a demanding position, you want to succeed, you got to have a passion. You want to have the intellectual rigor and the curiosity, and always, and a work ethic. I mean, there, some lucky one win like a billion dollar lottery, and people can get lucky. But for the most part, I think it's the intelligence, the discipline, and the hard work that gets you to, and the passion gets you to where you want to get in life.
And these two have all of those qualities in spades. So, at any rate, thank you both so much. And thank you, Sarah. What a great. Thank you very much.